Day everyone, welcome to Nestlé's first half results for FY21. In this presentation, we'll quickly go through the company's results, and then we'll move on to the valuation, which will then justify our neutral recommendation on the stock. Just looking at our executive summary, the key highlights from the results was pet care, Nestlé Health Science, and coffee continue to be key drivers. At home showed resilience in the second quarter, with like-for-like sales up 5.4%. Working from home, pet parenting, as well as health and immunity are three long-term effects beyond COVID times. Out of home demand also rebounded, with revenue up 4.1%. Just speaking to commentary from management, they've guided that they're expecting raw material inflation in the second half of the year. Just further dissecting the results, organic revenue was up 8%. Of this, volume was up 6.8%, with pricing only up 1.3%. But when we take into account adverse impacts of currency, the reported sales then only rose 1.5%. So in that regard, they were actually a miss in terms of expectations. But trading profit, the operating profit margin fell by 20 basis points to 16.7%. Adjusted EPS was up 8.3%. The company also repurchased some of its shares, and it will carry on repurchasing shares for the next 3 years or so. Following the release of the results, the share price was down, but when we look at how it's performed since our last recommendation, it's been down 10.9%. Since the 29th of March, which was our last neutral guidance, while the benchmark has been up 13.1% over the same period. So in that regard, the company has underperformed the benchmark. When we're looking at earnings expectations for FY21, the market expects to see positive earnings revisions, with earnings expected to grow at least 5% in FY21 and a further 6.9% in FY22. We think that this is on the back of Nestlé having rationalized its portfolio over the last 2 years by scaling down lower margin products. And we've seen how this has grown the top line growth as well as the market share at large. Coming to our Thesis, we see the company as a quality stock with strong cash generation and balance sheet. We are encouraged by volume-led healthy sales growth, and we see this momentum continuing in the second half of the year into mid-term. As you can also see on the graph, they've maintained that volume growth as opposed to investing more in pricing. And I think they are then better poised in the sector in terms of being able to withstand the COVID headwinds. Also, their strong brands have to some extent helped the company command strong pricing. This is evident in their sustained margins despite COVID-related supply chain disruptions. For instance, Other peers have come out and they have issued a cautionary tone with regards to input prices going up, and Nestlé has said they're only expecting around 50 basis points impact in terms of their overall margins due to the input costs as well as their recent acquisition costs. So that is again testament to strong brands and stronger margins. In terms of valuation, on a forward PE basis, the company trades at a premium of 12.8% to its long-term average of 21.8 times and at a 3.5% premium to its FactSet peers. We feel that the premium is justified given the quality of the stock, and we maintain a neutral positioning on the counter. Should you wish to place a trade with us, please speak to your financial advisor or contact the dealing desk. We would also encourage you to go through the full reports on the stock, which can be found on my base. Before we end off, please take note of the following disclaimer. Thank you.